We're jumping straight into advanced micro devices today. Everyone is watching the price action, but the real story is the massive AI infrastructure spending surge that is reshaping their entire balance sheet. And, you might see the stock surging, 7 or 8% alongside peers like NVIDIA and Broadcom. But
Yeah.
when you look under the hood, the numbers suggest this isn't just hype. It's a fundamental shift in how this company makes money.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds on these record-breaking numbers, make sure you subscribe and hit the like button. That way you won't miss any of our market simplified breakdowns. We are tracking the money so you don't have to. Okay, so I want to start by setting the stage here. Because if you follow the semiconductor space for, say, the last 10 or 15 years, this company has always had a specific reputation.
Oh, yeah.
They were the scrappy underdog, the Pepsi to Intel's Coke, the budget option you'd put in a gaming PC when you couldn't quite afford the top-tier stuff.
Yeah, that's a really fair characterization of the history. For a long, long time, the investment thesis was purely about value and just being good enough.
Right.
But if you are still holding on to that mental model today, you are looking at the wrong company. I mean, the information we have in front of us paints a picture of a total corporate metamorphosis.
Management is throwing around the word inflection a lot. I've noticed that.
They are. And, usually I have a visceral reaction to CEOs using the word inflection.
It's corporate speak.
It's often just corporate speak for, we promise things are about to get better, please don't sell. But in this specific case, when you dig into the Q4 2025 data, the math,
Yeah.
it actually supports the vocabulary.
It really does. I was looking at the top-line numbers for the fourth quarter of 2025. Revenue hit $10.3 billion.
Mm-hmm.
That didn't just meet expectations, it comfortably beat the consensus, which was sitting around, $9.67 billion? But for me, and I think for anyone trying to understand the future of this stock, the headline number is almost irrelevant compared to the composition of that number.
That is the single most important takeaway. You have to look at where the cash is actually coming from.
Exactly.
For years, investors looked at this brand and thought about gaming consoles, powering a PlayStation or an Xbox or maybe the processor inside a laptop.
Sure.
And look, if you look at the client segment, which covers those PC and laptop chips, it's doing fine. It hit a record $3.1 billion in the quarter.
So the legacy business isn't dying, it's actually healthy.
It's very healthy, but it's not the driver anymore. It's the steady paycheck, not the lottery ticket. The engine has completely shifted. The star of the show is now, unequivocally, the data center revenue.
The numbers here are honestly kind of hard to wrap your head around, given where they were just 2 years ago.
Yeah.
We're talking about a record $16.6 billion for the full year of 2025.
Right, and that is up 32% year over year.
32%.
And if you think 32% is impressive, look at the acceleration. If you zoom in on just the fourth quarter, the growth curve it goes vertical. That segment grew 39% just in Q4 to reach $5.4 billion.
Hold on. Let's just pause there for a second. 39% growth in a single quarter. For a hardware segment that is already doing billions in sales,
Yeah.
that feels like startup numbers, not massive cap semiconductor numbers.
It's exceptionally rare. It signals that the market has an absolutely insatiable appetite for what they are selling.
Which is what?
Exactly. They're selling the infrastructure for the AI revolution. This isn't about selling chips for someone to play video games anymore. This is about selling the pickaxes and shovels, or maybe more like the heavy industrial drilling equipment for the AI gold rush.
And they aren't being shy about the future either. I saw a projection in the notes that made me do a double take. They're projecting greater than 60% annual growth in the data center segment over the next 3 to 5 years.
That is a staggering projection. 60% KGR compound annual growth rate for a business unit that's already at a $16 billion run rate. That implies they believe we are nowhere near the peak of AI spending.
It implies the build-out is just getting started.
Just getting started.
Okay, so let's talk about the actual hardware driving this, because I want to make sure we aren't just throwing around buzzwords. The growth is driven by EPYC CPUs and Instinct GPUs. For someone listening who isn't a systems architect, can we break down the difference? What's the brain and what's the muscle?
That's the perfect way to frame it. The EPYC CPUs are the brains. They're the central processing units. They run the operating systems. They manage the data flow, all the traditional server tasks.
Sure.
They're incredibly powerful. And by the way, they are stealing huge market share from Intel. But the Instinct GPUs, That's the muscle.
That's the AI part.
That is the AI part, exactly. GPU stands for graphics processing unit, but in the context of AI, they're doing the heavy mathematical lifting to train models like GPT-5 or Claude.
And this brings us to the moat. Because for a long time, the bear case on this stock was simple. They're just the second option to NVIDIA. You only buy them if NVIDIA is sold out.
Right. The Pepsi argument all over again. But
Yeah.
that narrative is just crumbling. It's not just about raw power anymore. It's about the whole ecosystem. They've built an IP moat around these chips. But the real validator, the thing that just kills that second best argument, is the partnership data we're seeing.
You're talking about the OpenAI news.
I am. This is the smoking gun for the bull case. The commitment from OpenAI is massive. We are talking about a commitment for 6 gigawatts of compute using the MI450 chips starting in late 2026.
I want to stop and dwell on 6 gigawatts for a second, because in the tech world, we get used to big numbers, gigabytes, terabytes. But gigawatts, it's a measure of electrical power. 1.21 gigawatts was enough to send Marty McFly back to the future. 6 gigawatts is a medium-sized country.
It's enormous. To give you a realistic scale, a massive hyperscale data center campus might consume 100 to 200 megawatts. A gigawatt is 1,000 megawatts, so 6 gigawatts is roughly the power consumption of millions of homes.
So when OpenAI says, we need 6 gigawatts of your chips, they are planning infrastructure on a planetary scale.
A planetary scale. And you don't do that if the chips are second rate. You don't build a 6 gigawatt facility on budget hardware.
You don't bet the future of your company.
And arguably the future of AGI on hardware you don't trust.
Precisely. This proves that the MI450 chips can compete at the absolute highest level against NVIDIA's Blackwell or whatever comes next.
So they are winning the high-end AI fight. And at the same time, you mentioned they're beating Intel.
Yes, they are fighting a two-front war. On the GPU front, they are battling NVIDIA. On the CPU front, they are battling Intel. And the data shows they hit their highest ever server CPU market share in Q4. They're taking ground on both sides of the battlefield. That sounds expensive, though. Usually when you fight a war on two fronts, you have to slash prices to win business and your margins get crushed. Is that happening here?
Surprisingly, no. And this is where the financial health part of this really comes in. They are actually targeting higher margins.
Yeah.
In Q4, data center margins were around 25%. They have laid out a clear roadmap to get that to 35% by late 2026.
How? Efficiency gains, does that just mean manufacturing them cheaper?
It's a mix. It's better yields from the foundries, so fewer broken chips per wafer, and it's also product mix. As they sell more of these high-end AI chips to OpenAI and Microsoft, the average selling price just goes way up.
Which lifts the margin for the whole segment.
Yep, and that flows right down to the bottom line. I mean, net income was $6.8 billion. They are incredibly profitable.
And I love where that money's going. A lot of mature tech companies just use their cash to buy back stock.
Right. It boosts the EPS, makes shareholders happy in the short term, but it doesn't really build the future. Here, they are reinvesting heavily in R&D.
They are feeding the machine.
They're funding the ramp-up of the MI450 and the next generation of architectures. This signals that management sees themselves in growth mode. They are playing to win, not just playing to maintain.
Okay, so let's recap the bull case before we switch gears. Revenue is exploding. The data center business is growing at 60% a year. OpenAI is betting the farm on their chips, and they're profitable enough to fund their own war chest.
Sounds pretty good.
It sounds like a slam dunk.
Yeah.
But we're the easy money show. We don't do blind optimism. We have to look at the other side of the ledger.
There's always another side.
Because there are some very dark clouds on the horizon, and some of them are shaped like geopolitical borders.
We have to pivot to the risks. Because while the U.S. story is amazing, the international story has a massive hole in it. We need to talk about the China problem.
I know there have been export controls for a while, preventing the highest-end chips from going to China. But how bad is the actual forecast?
It's severe. Due to tightening U.S. trade dynamics, revenue from China is expected to essentially fall off a cliff. We're looking at a drop to roughly $100 million in Q1 of 2026.
Can you contextualize that? Is $100 million a lot or a little for that region?
It represents a 75% decline.
Ouch. A 75% haircut on an entire region.
Correct. In real dollars, this potentially shorts the company anywhere from $400 to $800 million annually compared to previous run rates.
So that's high margin revenue that is simply vanishing.
Vanishing. It's not because the customers don't want the product, it's because the government won't let them sell it.
Which means, effectively, the domestic and European markets have to run even faster just to stand still and cover that loss.
Precisely. The growth in the U.S. data center has to be massive, not just to grow the total pie, but to mask the slice that just got cut out. And this brings us to the second major risk, execution.
Right.
Because if you need to sell more in the U.S. to make up for China, you better be able to actually build the chips.
And that's the bottleneck we keep hearing about, HBM. 3 letters that seem to be keeping supply chain managers awake at night. Can you break this down? What is HBM and why is it so hard to get?
So HBM stands for high bandwidth memory. To use a traffic analogy, imagine your standard computer memory is like a 2-lane road. It gets data to the processor, but there's a speed limit. AI requires massive amounts of data to be fed into the GPU instantly. HBM is like building a 20-lane superhighway directly on top of the chip.
So without HBM, the GPU is just a Ferrari sitting in traffic.
Exactly. The chip is useless without the memory bandwidth. And the problem is, manufacturing HBM is incredibly difficult. There are only 3 major players, SK Hynix, Samsung, and Micron, and their capacity is completely booked out.
So even if Advanced Micro Devices has a purchase order from Amazon for $1 billion worth of chips, if they can't get the HBM from Samsung, they can't ship.
They cannot ship. They cannot recognize the revenue. They could be sold out on paper, but have empty warehouses. And there's another technical snag we need to mention, UA-Link.
UA-Link. Okay, another acronym. Let's decode it.
It stands for Ultra Accelerator Link. It's an open standard interconnect technology. Basically, if you want to hook up 10,000 GPUs to work as a single brain for OpenAI, you need a way for them to talk to each other incredibly fast. That's UA-Link.
Now, what's the issue there?
There are fears of delays in the validation of that technology. If UA-Link gets delayed, it pushes back the deployment of the MI450 chips. It could push that revenue realization from late 2026 into 2027.
So instead of seeing that money this year, we wait another 12 months.
That is the risk. And think about the stock price. The market is pricing the stock based on immediate explosive growth.
Right.
In a market like this, time is money. A delay of 6 to 12 months changes the discounted cash flow model significantly.
And let's talk about that pricing. Because as we said at the top, the stock is up, sentiment is high.
And that's the priced-in reality. We track sentiment scores, and right now this name is sitting at an 8 out of 10 for bullishness. That's great, but it's also dangerous. It means the market has already read the good news. They expect the beat. They expect the guidance raise.
It's the curse of high expectations.
It is. When you are priced for perfection, a minor miss, say, margins come in at 34% instead of 35%, or OPEX rises a little too fast, you get punished. We've seen stocks drop 10 or 15% overnight on a good earnings report just because it wasn't a great one.
So we have a clear bull case, AI revolution, OpenAI partnership, technical parity. And we have a clear bear case, China revenue hole, HBM shortages, and perfection priced in. For the listener holding this or thinking about buying, let's make this actionable. What are we watching in the next 30 to 90 days?
I have 3 specific catalysts circled in red on my calendar. First, obviously, is the Q1 earnings report.
That should be dropping late April or early May 2026. What's the magic number we're looking for?
You want to watch the guidance. Forget the past quarter, look at the forecast. The target is $9.8 billion for the quarter.
$9.8 billion. Got it.
If they guide for $9.8 billion or higher, the growth story is intact. If they guide lower, the market will immediately panic that the China drop is hurting more than expected or that the HBM shortage is capping their ability to ship. $9.8 billion is the line in the sand.
Okay, catalyst number 2.
Macro signals, specifically capital expenditure CapEx from the hyperscalers. You need to be watching Amazon and Alphabet.
Connect the dots there for me. Why does an Amazon earnings call matter so much for this chip maker?
Because Amazon is the customer. The rally we've seen in this stock is linked directly to Amazon and Alphabet increasing their AI spending budgets. If big tech continues to spend, this company earns.
So it's almost a derivative trade.
100%. If you hear Amazon's CFO say, "We are increasing our infrastructure spend for AI," that is a huge buy signal for the chip manufacturers. If they say, "We're pausing to digest our current capacity," or, "We're optimizing efficiency," look out below.
Got it. Listen to the customers. And finally, what about the product side?
We're just coming out of CES 2026. There was a lot of flash, a lot of demos. We saw the Helios Rex. We saw the MI440X reveals. Now we need proof of life.
Proof of life.
We need to see actual deployment. I want to see press releases that say Microsoft is deploying Helios racks in their Virginia data center. Not we are partnering, but we are installing. There's a big difference between a PowerPoint partnership and hardware on the floor.
Right. We want to see blinking lights in a server room, not just logos on a slide.
Exactly.
Okay, let's bring this home. We've covered a lot of ground. 2026 is shaping up to be the year this company tries to shed its underdog skin once and for all. They want to prove they're a primary player, not just a backup plan.
They have all the pieces on the board to do it.
But, and here's where I want to leave you thinking, the CEO calls this an inflection year, and the numbers back that up. But remember the context. They are attempting this massive ramp-up while their China revenue effectively vanishes. That safety net, it's gone.
It's a high-wire act without a net.
It is. The entire investment thesis now rests on this AI data center gamble paying off immediately. So ask yourself this. If the AI spending from Amazon or Google slows down for even a single quarter, does the growth story hold up?
Without that China revenue to buffer the books, a slowdown in U.S. AI spending leaves them very, very exposed.
It's a high-reward strategy, but the risk profile has definitely changed. You aren't buying a safe utility stock here. You're buying a ticket on a rocket ship that has to outrun a collapsing bridge behind it.
That is a very vivid and accurate way to put it.
Something to chew on before you place your trades. That's it for us today on the Easy Money Show. Stay liquid, stay curious. See you next time.